morning. Nice to see so many join in on a Saturday morning. I don't have a presentation. My view is that if you're not able to convince anyone in India to invest in equity markets in 5 to 10 minutes, you'll never be able to convince them, even if you have hundreds of slides. So I think what I'll try to do is obviously give our perspective on the challenging times which we have had over the last 15, 18 months. But obviously, as a die-hard optimist, and I've remained that for the last 25, 30 years, and it's paid off well, give our perspective of why we are extremely optimistic going forward. Obviously, touch upon a few, I would say, very trending discussion points, impact of AI on companies, impact of AI on our businesses, and so on and so forth. Just to take you back a little bit, I think 2020 is when the markets had one of the very recent big fears, which was the pandemic. And I think it was very scary because it was not only about wealth, it was also about health. But since then, whoever stayed positive or whoever stayed positive ended up having great wealth and great health. I think the next 4 years, we had one of the best, I would say, times for which any investor in Indian markets would have had. Smaller companies went up 4-5x, the index went up to 2.5x. And in 24, we were all like believing that this is going to continue forever, which always happens, the way we believe that gold and silver is going to continue forever. And we also had elections. So I think what happened was, one, we became very expensive, and second, we also had a slowdown in the economy. Because for politicians, the number 1 to number 10 objective is to win elections. All of us come after number 11, and when elections happen, there is a code of conduct, things slow down. And that is exactly in September 24, we saw GDP slow down to 5%. Corporate profit growth, which is a key component of expecting any kind of returns in the equity markets, that slowed down to only 3%. It also coincided with a period where Indian valuations had become 50% more expensive than the emerging market index valuations, 50% more. It was the highest we have seen since emerging markets became a separate asset class. And we also had a phenomena in the world where global investors were looking increasingly towards increasing their weight towards high-tech companies. So AI and data centers and semicon and chips and all had started to come in a big manner in everyone's life and news flow towards the mid of 24. So on one hand, we had Indian markets which were expensive, you had other markets which were cheaper, and you had Indian markets slowing, or Indian corporate growth slowing down, and you also had absence of high-tech companies in our listed space. I think all this meant that foreigners found it very easy to take money out of India and invest in some of the other countries like Korea and Taiwan and China and Japan and also US. We had 8 wars as per Trump, which he has settled. But anyway, I think we had one closer home, which was India-Pakistan. After more than 50 years, we were actually in a warlike situation. And that also caused on and off risk of kind of a situation. Last but not the least, the Trump tariff came into being. January 25 was a time when Trump became the president again. And since then, this tariff thing has been like a roller coaster ride. One day tariffs, the other day no tariffs. And for India, actually, it was a very unpleasant kind of a scenario because we believed that India was friends with the US and we will get a preferential treatment. But what happened was actually the reverse. We were slapped with a 50% tariff, 25% tariff and 25% penal tariff for buying oil from Russia. And we were only one of the 2 countries in the world. India and Brazil were the only 2 countries in the world which had a 50% tariff. So I think a lot of negatives got combined in 15, 18 months. And therefore, you saw Indian markets underperform massively. However, every adversity also has some silver lining. Indian government in particular acts decisively when pushed to the wall. I think the reason why your business and our business flourished post-COVID was because of COVID, because during COVID, we were all allowed to have digital onboarding and so many other ease of doing business. I think even in 25, because we were pushed to the wall, the government started to act. So because the economy slowed down in September 24, we had an income tax cut of 1 lakh crore in February 25 in the budget. Because of tariffs and because of the government need to support the domestic industry, we had GST rationalization and GST rate cuts, again a benefit of 1 lakh crore. We had an RBI governor who also understood that the economy needed a boost. So 10 lakh crores of additional liquidity was pumped in 2025. We had 125 basis points of rate cut. And unlike his predecessor who was trying to contain credit growth, I think the new RBI governor started to encourage credit growth. And the effect of all of that is clearly seen. You know, if you see the consumption pattern post September 25, when the GST cuts came into effect, whether it is car sales, two-wheeler sales, tractor sales, commercial vehicle sales, retail sales, I think all of them are growing upwards of 15-20% depending on the product. And we're already seeing the effect of that. On the tariff front also, because we were pushed to the wall, I think India went ahead and signed 22 FTAs in the last 6 to 9 months. 22 FTAs, it's never happened before. From smaller economies like Mauritius to Middle East to New Zealand to some very large FTAs, one of its kind FTA, one with UK, which should get implemented in June, and the mother of all with the EU, which should get implemented in September. Now, EU as a region, the economy is larger than the US. And I think to some extent, all this FTAs signing happening in such rapid succession was only possible because of the US stance on tariff and because of the very aggressive and I would say some insulting tone which the President, Mr. Trump, was using against other economies. And even on the US tariff front, even before the Supreme Court order, I think the US had already reduced the tariff on India to 18%. 25% became immediately applicable and 18% was to be applicable in the first week of March. In the meantime or in the interim, the Supreme Court of US nullified or termed the Trump tariff as illegal. And as we speak, Mr. Trump had already notified a 10% duty, which he said he'll take it to 15, but right now the notification is only of 10%. Even if it goes to 15%, including the 3.5% tariff, which was already existence, I think India will be at 18% max, which places it in line with all other countries. In fact, before this, India was at 50, Brazil was at 50, some countries were at 35, some countries were at 18, some were at 10. I think with this now, all the countries will be equal. And in fact, China's tariff will remain at 25 to 50% because it is through a different act. So I think India will stand to gain a little bit. What will also happen is that even when the tariffs were at 50%, India's exports to US did not go down. They did not rise, but they did not go down. So India's exports to the US were irreplaceable. However, the importers were buying only what was needed immediately. Now with this tariff coming down, they will also be restocking. So our view is that between March to June, you will in fact see exports rising significantly faster because they will also be restocking. We had a big event called budget. I think the day of the budget, we were all unhappy because of the STT thing. But actually, if you see the underlying of the budget was pretty strong. Fiscal prudence was maintained. India's fiscal deficit this year is slated to be 4.4, next year going to 4.3. The quality of spending has improved dramatically. So earlier, like as late as 2023, out of the 100 rupee budget, 75% was being spent on revenue expenditure. So it was to just meet the expenses of managing the country. Only 25% was being spent on capital expenditure, which is building assets. By 27, this 25% will increase to 32%, and revenue expenditure will reduce from 75% to 68%. So the quality of expenditure is also improving dramatically. On the debt to GDP, India's debt to GDP is now down to 55%, which is again the lowest in the world. And that also, the target is to bring it down to 50%. If you look at any other economy, developed economies like 130, 140, 150%, Japan is at 200%. And with this 50 to 55% debt to GDP, India's economy comes across as one of the most resilient economies of the world. On GDP growth, things continue to be pretty decent. Even today's headlines, have shown India's GDP growth as 7.8% for Q3, which is miles ahead of any other country in the world. In terms of other parameters, I think January onwards, we have started to see great growth on the capital goods side also. In fact, when we speak to some cement companies, double-digit growth after almost 3-4 years. Steel companies are also saying the same thing. When we look at e-way bills, when you look at GST collections, I think all are trending pretty decent. Auto sales obviously continue to do very, very well. And hopefully with this tariff issue solved, we will also start to see exports picking up. Most important thing for equity returns is corporate profit growth. I think it had slowed down meaningfully, as I mentioned, in September 24. December 25 quarter is the first quarter in 7 quarters where earnings have come marginally better than analyst expectations. More importantly, the large cap earning growth has been 10.5%, but the mid and small cap earning growth is a significant higher 15 to 19%. And that again shows that at the grassroots level now, things are improving. From a foreign flow perspective, we have seen massive outflows last 15-18 months. However, 2 things have happened. One is, the premium of India's P multiple has come down to the 10-year average. India's P multiple 1 year forward has come down to 17.5 times, which is again the 10-year average. India's weightage in foreign emerging market portfolios, which was 21%, has come down to 13%. It has never been so low last 10 years. And the whole world, which was moving only towards investing in high-tech companies, is also now starting to get worried because of the sharp fall we have seen in so many companies in the world, which are predominantly in AI or semiconductors or chips and so on and so forth. And therefore, if you see February month, after a long time, we have seen net inflows as far as foreigners are concerned. So going forward, a combination of all the headwinds becoming tailwinds, tariff being solved, economy growing faster, corporate profit growing faster, hopefully even the foreign flows coming in, and stocks available at deep correction, I think our view has become quite positive. On the mid and small cap side, whenever markets move up, the mid and small cap move up faster. When they fall more. And I think that is what has happened over the last, I would say 18 months. Till 24, the small caps were doing phenomenally well. But when the markets corrected in the last 18 months, the small caps fell very, very sharply. In fact, if you see out of the 800 odd companies which are there between market cap of 2,000 to 35,000 crores, almost 400 companies have fallen more than 40% from their peak. I think the broad markets have corrected so massively that almost 50% of the small cap companies have fallen more than 40% from their peak. And our view is that the way on the upside there was overreaction, on the downside also there has been an overreaction. And anyway, our view from here on is of markets doing well. So our view is definitely that the smaller companies should also start to do well. There are a few things I would like to highlight before I touch upon the AI thing. See, India got independence in 1947. The first trillion of GDP took 60 years. By 2007, we reached $1 trillion of GDP. The next trillion took 9 years, the third took 8, the fourth took 7. After 78 years of independence, we are a $4 trillion economy. So after 78 years, all of us put together have created $4 trillion worth of wealth. Our view is that this 4 to 8 would take another 8 to 9 years. So the kind of wealth which has been created over the last 78 years, the same wealth is going to be created over the next 8 to 9 years. I think if you believe this, equities will always give you good returns. Obviously, the definition of good returns will have to be changed. We can't expect 20% returns year after year. It has to be more like, mid-double-digit kind of returns or mid-teen kind of returns. But that is the trend very, very clearly visible. The second thing is the composition of the GDP also changes. So the first trillion was contributed by the steel, the cement, the aluminum, the jute, and the textile companies. 1 trillion to 4 trillion was contributed by private banks coming in, IT services coming in, pharma coming in, and so many other new sectors coming in. 4 to 8 will again be contributed by very, very different kind of sectors. So maybe semicon, AI, defense, engineering, industrial products, niche pharma. And we have to be, as investors, be very clear that we are aware of what is going to happen, because the economy might go from 4 to 8, but if you still are in the old traditional sectors only, you might not be able to generate that kind of return. So I think that composition will change. The other thing we have to realize is the whole impact of the wealth effect. See, we have not made too much money in equity markets last 1.5 years. But as a country, we are the richest ever. And all of you, a few hundred people who are here, I can tell with a lot of confidence that the net worth of each one of us is at the highest level ever. Why? Because as a country, we are very diversified. All of us put together own $1 trillion worth of equity, including mutual funds. We had $1.2 trillion worth of gold 4 years back. I think that has increased now to $4.5 trillion worth of gold. So on a sum total, we are more wealthier than ever. And at least my view is that this wealth effect of gold, you will start to now see translating into consumption. See, all of us will have some gold. Even now, we will be having some gold. Obviously, the beautiful ladies will have more gold. But I'll just give you some basic example. 1.5 gram, only 1.5 gram of gold can buy you a scooty. Only 1.5 gram. Only 3 grams of gold can buy you a scooter. You can exchange 3 grams of gold for a scooter. 30 grams of gold can buy you a car. And I think that wealth effect will start to now get reflected. It is already starting to start coming in the economy by way of gold loans. But now increasingly you will start to also see that wealth effect getting translated into consumption. And I think that will be an added pillar of growth as far as India is concerned. On the capex side, I think whether it's the state government or the central government, both are pushing for infrastructure growth. A little bit of negative is there because all state governments want to give freebies when elections come. And I think now we have seen that even here. I have told that 5,000 rupees have been transferred in everyone's account. But that is a political compulsion. But irrespective, I think all state governments are looking at expanding infrastructure. So now you have a scenario where consumption as well as infra, both are going to fire together. I think I have a few minutes. I'll touch upon the AI side. There's a lot of noise about AI. AI was a buzzword. Now the moment someone talks about AI, stocks fall because you never know what is going to get impacted when. As human beings, we have always evolved, and when there were horse cart guys, when buses came, their profession got impacted. In the late 80s, early 90s, when computerization came, all the employees went on a strike that because of computerization, we will be left jobless, but nothing of that happened. I think the same thing on AI also. It's a means of increasing our efficiency. Only those who don't keep up to date are at risk of becoming redundant. Otherwise, AI will only increase your efficiency. And I think from an India perspective, IT services, which is a key, is reportedly at risk. Maybe yes, I don't know. We are significantly underweight IT services because anyway, the growth rates had slowed down. But it's not going to be the end of the day. I think we will have to now keep on evolving. And even for our profession, whether it is wealth management or asset management, I think we have to embrace it as our friend. So at Abakkus, I think we have already started using AI in a limited manner, and we intend to increase it more and more. It is making life easy, because what is AI? AI is analysis of huge amounts of data in very short period of time. So it's like our brain, but the brain also has limitation. AI does not have limitation because there are so many large computers which are connected with each other, and you can process that data because of this huge speed of the chips and the microprocessors, the hyperscalers, that you are able to analyze huge amounts of data in very quick period of time. And it is all upon us that we start to use it to make ourselves more efficient. From a equity market perspective, anything which comes in, it's human nature that any new thing which comes in, there is always a resistance, there is always a fear, there is always a change, anxiety which happens, and I think that is what we are seeing. But ultimately, I think all of us have to embrace AI. From an equity market perspective, we are in fact seeing it as an opportunity rather than a threat. But yes, we will have to be aware of what it is about. So I think in sum, I have always been positive on Indian markets, so my views should be taken with a pinch of salt. But we do believe that last 18 months of headwinds have now become tailwinds, and it is time to now look at equity asset class as the asset class which can give you the highest return from the next 4-5 years perspective, and that includes gold and silver. Thank you.